Good morning. This is Dylan Jovine with Behind the Markets. Happy Friday. Today is Friday, February 27th, last business day of the month, TGIF. Hope you all have a wonderful day and a wonderful weekend. And today I'm going to talk about Nvidia's earnings. Nvidia came out with great earnings yesterday, actually Wednesday night. And let me talk about them. Basically what you saw here is, let's look at the earnings to see what it says about actually the state of AI. There are a lot of clues in this that I thought I'd share with you. So first of all, for the fourth quarter, revenue was $68 billion, up 73% from the fourth quarter last year. Earnings for the fourth quarter were $42 billion. Think about that. $68 billion in revenue, $42 billion right to the bottom line. What does that tell you? That tells you that this is a company that has very low costs, that basically for every dollar they earn in revenue, what do we have? 50 cents, 60 cents is going right to the bottom line. Tells you this is really a company that's based a lot on design, very low cost, Here's where it's interesting. So really the last few years, you've seen Nvidia's revenue and earnings grow, 80%, 70%, 73%, really. But now you're starting to see Nvidia move to kind of a more mature phase of its growth cycle. What you're seeing here is basically, if you look at fourth quarter revenue sequentially versus Q3, it's up 20%. So basically you're starting to see that crazy year after year growth of 70% is starting to, normalize back down to like a 20% growth rate. Still a wildly profitable business. I mean, data center revenue year over year was up 75%, but over the quarter from Q4 versus Q3 was up 22%. And of course, amazing gross margins were 75%. Unbelievable. Basically, it tells you gross margins were 75%. What does that mean? That means that for every dollar in revenue they do, it costs 25 cents to actually make the thing. And then probably 15 cents in people, marketing, and equipment and all these other things. And then the rest goes right to the bottom line. And really, it's that gross margin number that tells you, A, what they're making is super cheap. B, you can see why other companies are really going in there and trying to make chips that they can sell, because this is what we call an abnormal profit. It's not sustainable. It's really big in the short term, but usually when you see profit margins like this, competitors come in and start to really offer chips, similar chips, and really chip away at that margin, basically, which would force Nvidia to lower prices. And these things happen over years. This is the nature of competition. What else does it tell us about? So it tells us the AI boom is still growing 20% sequentially, but the growth is more moderating, which is, terrific news. It tells you that their new Rubin line of chips looks very, very, very powerful. They're basically pushing that out. And by the way, that is based on, on architecture, on core CPUs from one of their secret suppliers that we've been talking about, which has been pushing, basically dominates 95% of all cell phones, is now pushing into data centers. And NVIDIA's secret supplier has 50%. And as NVIDIA's share of data centers grows, which is growing all the time, and their secret supplier that we've been talking about, we've been really kind of promoting here as a great way, a backdoor way to play NVIDIA, their business grows. So this is actually great for NVIDIA, this news, and great for their secret supplier. So, it's good stuff all around. But it shows you that the AI boom is getting a little bit more mature. It also shows you why Meta, for example, is cutting deals with AMD, why AMD is cutting deals like this. So Meta is incentivized to get NVIDIA to lower prices for chips. These chips are outrageous, and they have, these huge gross margins, which, make these chips expensive. These buyers of chips, the Mag 7, they would like NVIDIA to lower their prices. So they keep negotiating with companies like AMD to really try to get them to hope they bring them along, that they bring out chips that are very competitive with NVIDIA. So look, overall, this has been a heck of an earnings report. It shows that year over year, last year versus the year prior, growth was 75%. Unbelievable, unbelievable, really killer growth, 65%. But quarter over quarter, you're starting to see that 20% growth. So growth over year, if it just keeps going like this, is starting to moderate down to the 20% annual growth rate range, which is still fabulous. It's still fabulous. But those big leap ups that you're seeing, really isn't the game anymore. We're not really talking about 75% gains from here. We're talking about 20% gains in revenue from this much higher starting point, and that's why their shares didn't go crazy yesterday. I mean, it reported, it topped Wall Street's guidance, but again, year over year, sure, but sequentially, Wall Street says, okay, this is now a business growing. It looks like it's going to be a business growing at 20% a year. That's terrific. That's a great business to own, but we're not going to send shares up as if it's growing 75% sequentially quarter after quarter after quarter. Anyway, that's all I have. Have a wonderful day. Have a wonderful weekend, and I will see you Monday.